What happens when a country long defined by oil quietly reshapes the global diamond market, hitting record production and positioning itself just behind Russia and Botswana? Angola's latest numbers reveal more than a mining milestone. They point to a strategic shift that could alter power dynamics in one of the world's most tightly controlled commodity industries, with implications far beyond southern Africa. If this momentum accelerates, Angola could convert diamonds into a lasting economic lever and geopolitical asset. If it stalls, the country risks repeating the familiar cycle of resource booms without structural transformation. Success would deepen Angola's influence across supply chains, pricing, and governance. Failure would reinforce doubts about whether mineral wealth can truly drive diversification in resource-dependent states. To see why this matters now, it helps to trace Angola's economic and political trajectory. After decades of civil war ending in 2002, Angola rebuilt around oil exports, becoming Africa's second-largest crude producer. Oil revenues funded reconstruction, but also entrenched vulnerability to price swings. Diamonds, mined for over a century, remain significant yet under-leveraged, constrained by smuggling, weak infrastructure, and limited integration into global value chains. Over the past decade, reforms aim to formalize production, attract investment, and reposition state-owned firms as commercial actors rather than rent collectors. Endiama, Angola's state-owned diamond miner, sits at the center of this shift. In 2024, it produced 14 million carats of rough diamonds, the highest output in its history. That figure elevated Angola to the position of the world's third-largest producer by volume, trailing only Russia and Botswana. The scale matters because volume confers bargaining power in an industry where supply discipline shapes prices and market stability. For comparison, global rough diamond production has hovered around 120 to 130 million carats annually in recent years, placing Angola's contribution firmly in the top tier. The government now plans to push output further. Endiama has set a target of 17 million carats by 2027, implying an increase of roughly 21% over 3 years. Achieving this would require expanded operations at existing mines, accelerated development of new deposits, and sustained capital investment. It also assumes stable regulatory conditions and continued demand in a market facing long-term shifts, including competition from lab-grown diamonds and changing consumer preferences. Production growth is only one side of the strategy. Angola is also signaling ambitions upstream and downstream in the diamond ecosystem. Officials have disclosed that the state is exploring the acquisition of a minority stake between 20 and 30% in De Beers, the iconic diamond company currently owned by Anglo American. Such a stake would be jointly held by Endiama and Angola's national diamond trading firm, Sodium. While still under consideration, the move would mark a significant attempt by a producing country to gain influence inside one of the industry's most powerful institutions. De Beers has historically shaped global diamond supply through marketing, stockpiling, and long-term contracts. Even after the erosion of its monopoly, it remains central to pricing benchmarks and distribution networks. A minority stake would not confer control, but it would provide access, visibility, and leverage. It would also align Angola more closely with Botswana, which already holds a 15% stake in De Beers and has used that position to negotiate greater value retention and downstream activities. The timing is not accidental. Russia, the world's largest producer by volume through Alrosa, faces sanctions and market disruptions linked to geopolitical tensions. Botswana, long the second largest producer, is confronting declining output from mature mines and has signaled fiscal pressure as diamond revenues soften. Against this backdrop, Angola's rising output and institutional ambitions position it as a potential stabilizing force, or a disruptive one, depending on how it deploys its growing share. What if Angola succeeds in combining higher production with deeper integration into the global value chain? In that scenario, diamonds could become a pillar of economic diversification, reducing reliance on oil revenues that fluctuate with global energy cycles. Greater influence within De Beers could help Angola shape marketing strategies, supply discipline, and even narratives around ethical sourcing, enhancing its soft power. Regionally, this could shift investment flows toward Angola's mining sector, strengthening its role within the Southern African development community. What if the plan encounters resistance or market headwinds? Acquiring a stake in De Beers would require alignment with existing shareholders and regulators, and any perception of politicization could unsettle buyers. If global demand weakens or lab-grown diamonds gain market share faster than expected, increased volume could pressure prices, undermining revenues. Domestically, rapid expansion without parallel governance improvements could revive concerns about transparency, revenue management, and local community impacts. The geopolitical consequences extend beyond diamonds. Angola's strategy reflects a broader African push to assert greater control over natural resources and capture more value domestically. It echoes debates seen in lithium, copper, and rare earths, where producer countries seek to move from extraction to influence. For external powers and multinational firms, this raises questions about access, partnerships, and risk. For Angola, it is a test of whether state-owned enterprises can operate competitively while serving national objectives. Numbers alone do not guarantee leverage. The difference lies in coordination, credibility, and timing. Angola's 14 million carats in 2024 established credibility. The 17 million carat target by 2027 sets a measurable benchmark. The potential De Beers stake introduces a strategic dimension that goes beyond tonnage. Together, they suggest a deliberate attempt to translate geology into influence. As this story unfolds, several indicators will matter. Watch whether investment commitments materialize to support higher output, how negotiations around De Beers evolve, and how Angola manages the balance between volume growth and market stability. In the end, this is a story about power and patience. Diamonds are finite, markets are cyclical, and influence is built incrementally. Angola's current trajectory shows intent and momentum, but the outcome will depend on execution in a volatile global environment.